Welcome to the Vestor Pulse. We're diving deep again this week, pulling out the key takeaways for you on markets, regulation, and some big infrastructure moves.
There's a lot to cover.
Yeah, definitely. Okay, let's unpack this. We really have to start with the Vestor product updates first. I mean, if you're trying to track this market, speed is everything.
Exactly. Let's start right there. So for anyone maybe newer to Vestor, it runs on those three core intelligence agents, right? You've got the on-chain agent, the news and sentiment agent, and the quant agent.
And the big news this time isn't just like a minor fix. Sources say it's more of a structural upgrade.
That's right. The outputs are much more structured now. Visualizations are cleaner. It's a noticeable step up.
Okay, but what's the biggest operational win you've seen from the inside? What feels different?
Performance, hands down. Latency on those really complex multi-agent queries, it's dropped significantly. And chart rendering is just solid now, consistent.
That makes sense.
Yeah.
It's the result of, what, a month or more of iteration?
Yeah, exactly. It's not just nice to have when the market's moving like this. It's essential.
And that speed boost couldn't have come at a better time because, well, the whole crypto market decided to take a breather this week.
A bit more than a breather, maybe?
Yeah, fair point. Total market cap pulled back to around $3.96 trillion.
Yeah.
Pretty broad cooling off after that big run.
Yeah, and it wasn't exactly gentle. Bitcoin dipped about 4%, settled around $112,122.
But Ethereum fell even harder, right?
Yeah.
Over 6% down to $4,184.
Right. And that often happens. Ethereum tends to have a higher beta, it reacts more strongly when the market gets nervous. Plus, so much DeFi and NFT activity sits on its chain, so it feels that risk-off sentiment maybe more acutely.
Which leads us to the sector pain. That was really concentrated, wasn't it? The GMCI DeFi index.
Oof, yeah, that got hit hard, down 11.9% to $87.08.
That's one of its biggest weekly drops in months, right? Is that just risk assets getting dumped or something more systemic in DeFi?
I'd say it's mostly a risk flush, leverage unwinding. But when you see a drop like that across the index, it means protocols pretty much across the board lost ground. Anything tied to lending, yield farming, they felt maximum pressure.
Okay, so charts consolidating, but the institutional build-out just keeps rolling. BitGo, let's talk about that.
Ah, yes, the IPO filing.
Filed to go public on the NYSE, ticker BTGO.
All right.
I mean, this is one of the oldest custody providers out there.
Absolutely. Managing over $3 billion in assets. And crucially, they operate WBTC, wrapped Bitcoin. That's key infrastructure.
So why go public now? What do the financials look like?
Well, the timing makes sense when you see the revenue.
Yeah.
$37.5 million in the first half of 2025. That's a four-fold increase year over year. Huge growth.
But there's a catch.
Yeah. The net income actually fell slightly, down to $6.3 million. And that points to the cost of scaling up, getting everything compliant. It's expensive.
So what's the real significance here? The so what?
The big deal is, if they list, BitGo becomes the first standalone crypto custodian trading publicly in the U.S. It'll be a really important proxy for how investors value these core infrastructure plays. This isn't speculation, it's the plumbing.
Okay, here's where the plumbing meets the, let's say, the party. This regulatory pivot feels really interesting.
You mean the ETF standards?
Exactly. The SEC approved generic listing standards on September 18th. That alone streamlines the whole process for digital asset products. Big news.
It is major, yeah. But what happened next is what really shifted the narrative, didn't it?
You got it. REX Shares launches the first Dogecoin ETF, DOJE, just days later.
Dogecoin.
I know. A token literally started as a joke, now wrapped up in a regulated ETF. What does this signal about the regulatory stance?
It completely blurs the lines, doesn't it? It suggests the regulators are maybe focusing more on the wrapper, the ETF structure, the custody, the compliance, than the origin story of the underlying asset.
So even if it's a meme, if it can be packaged correctly,
it seems like it's potentially fair game. It's a huge step towards just absorbing everything into traditional finance structures.
Wow. Okay, while the U.S. is figuring out meme ETFs, Bahrain's moving decisively on stablecoins.
Yeah, they introduced a new law, formalizing the rules, licensing, reserves, redemption, audits, the whole package.
Pretty comprehensive.
Very. And it positions Bahrain as one of the first movers in the Middle East on this, specifically focusing on fiat-backed stablecoins. They're clearly aiming to attract that kind of innovation with regulatory clarity.
Smart move, offering certainty where others are still, well, waffling.
Exactly.
Okay, one last thing to highlight amidst all the volatility, an outlier token. Trust Wallet Token, TWT, jumped over 30%.
Yeah, TWT saw a big spike. It's the utility and governance token for the Trust Wallet, that popular self-custody wallet.
So why the resilience now?
Two main things, I think. First, there are no ongoing emissions, so less sell pressure from dilution. Second, when the market gets shaky like this, people start thinking more about self-custody, controlling their own keys. So non-custodial tools like Trust Wallet get renewed attention.
Right, a sort of flight to safety within the user base itself, benefiting a mid-cap token.
Precisely.
So let's tie this all together. We've got this convergence, right? Hardcore institutional infrastructure like custody IPOs and stablecoin laws on one side, and then the launch of something wildly speculative like a Dogecoin ETF on the other. What does this mix tell us about where things are headed?
I think if you connect those dots, it points towards a rapid blurring of the lines. The functional difference between what we used to call risky crypto speculation and legitimate financial instruments, it seems to be eroding fast. If it can be packaged, custodied, and regulated within an existing framework like an ETF, its origin seems to matter less and less.
Which leaves us with that final provocative thought for you, the listener, to chew on. Is the traditional structure of capital markets just destined to absorb all crypto assets, no matter how they started? And will that fundamentally change what we even consider a blue chip investment? Something to think about.